What a time to meet. The election result has come completely against market and exit poll expectation. Markets moved up on the exit poll excitement, came to reality on the day of election results, and today it is back as if nothing has happened. If you had left office on Friday and resumed on Thursday, you would not have noticed this big volatility. Coming to global economy, well, the pitch is changing, and it's a pitch where even United States of America kind of team can defeat talented team like Pakistan. When China was growing, there was globalization. Everyone wanted goods from China. Now there is protectionism, deglobalization. Last 20 years since subprime crisis, we saw fiscal and monetary stimulus, interest rates at 0%, fiscal deficit at double digit. Now interest rates are high and there is withdrawal of fiscal stimulus. Environmental norms were there before, but now it is far more stricter. Compared to China, we have limitation of autocracy versus democracy. We can't have undervalued currency like China had in the early 90s to mid 90s. We can't violate IPR regulations like China has done. And more importantly, being autocratic country, their ability to execute things is far, far superior to India. Within that changing global scenario, inflation has started easing off in most parts of the world. Seeing interest rates coming down, there are countries which have started cutting rates. Brazil, Chile, Peru, Sweden, Colombia. Yesterday, Bank of England and Bank of Canada also cut rates. Indonesia is sole exception, which has raised interest rates to protect their currency. Overall, we are seeing that trade restrictions are increasing, as I mentioned before, that there is problem of deglobalization. Of course, Israel-Hamas war in Middle East, Russia-Ukraine war in Eastern Europe, and China-Taiwan problem in South China Sea increases geopolitical risk significantly. Commodity prices have gone up on hoarding by China. They have been buying large quantity of nickel, aluminium, copper, tin, gold, and such other commodities. Can that rising commodity prices, as is being seen over here, start pulling up the inflation which has been falling down with great effort from Fed? This turnaround will be something which we'll have to keenly observe. As of today, the market is neither believing soft lending or hard lending. It is more believing status quo at this point of time, which means subdued growth, but also subdued inflation. In China, people are seeing recovery shoots, albeit it is not explainable by the numbers. But some of the tidbits coming out of China seems to be showing that China will grow at 5% plus. IMF, on the back of growth estimates in China, believes that world over global growth will be maintained at around 3% level, led by India, which will be at 6.8%, China, which could be between 4.6 to 5%, and emerging markets, which will be around 4%. India is becoming engine of global growth along with China and America. One big challenge for the global system is huge capacity created by China. 85 to 97% of solar products are manufactured in China. 86% of batteries, 50% of footwear are manufactured in China. 70% of air conditions are manufactured in China. All this thing is creating pressure on other countries. One important thing to remember while looking at global equity markets, especially in America, there is lack of primary issuances. The buybacks are so much that net issuances have turned negative. This has potentially impact on valuation as too much money will be chasing too few stocks. Coming to US economy, Fed has raised interest rates at the fastest pace in their history, and it has been calibrated in taking out liquidity. Till now, over 2 years, it has taken out just about 25%, one third of liquidity which it had added in the system. Why Fed is behaving in a calibrated manner? Well, in America now, growth is dependent upon debt. Their debt to growth ratio is almost becoming 2 times. For generating $300 billion of economic growth, they have to borrow $600 billion of debt. As they keep on borrowing, the debt issuances keeps on building up. And now it is estimated that in 8 years, US debt will go from 20 trillion to 40 trillion. Currently, it is at 35 trillion. Their run rate is $1 trillion increase every 100 days. When you accumulate so much debt and your interest rates are high, obviously interest cost goes up. Right now, US interest cost is in excess of $1 trillion, and it is estimated to touch $1.6 trillion by December 2025. US economy looks like slowing down a little bit, but manufacturing in US seems to have bottomed out, courtesy protectionism. Employment is at very, very high level, and now it looks like that unemployment may start rising. Of course, it has a long distance to cover, but at least there seems to be bottoming out in the unemployment levels. There are certain factors to watch out for US economy. One is commercial real estate. Many US commercial real estates are today trading substantially below their purchase price few years back. The consumer confidence has also come down a little bit. Both these things put together put a spanner on American economy. Right now, the chances of US economy slowing down also increases, apart from commercial real estate and consumer confidence, on the impact of real interest rates. If you noticed in 2010, when real interest rates remained in the higher range, it was followed by a recession. Now, after a gap of almost 15 years, US interest rates are in real terms 2.5%, comparable to what was before 2010. Can now US recession come? A lot will depend upon how this interest rate starts coming down. All this complexities is forcing Fed also to give completely different prediction. Virtually around the same time, one Fed board member said, don't expect rate cuts. One said there should be 1 rate cut, and others said there should be 3 rate cuts. American fixed income market today is at a stage where green signal is also on for rate cut, red signal is also on for no rate cut, and yellow signal is also on for one potential rate cut. One thing which we will have to watch, America is imposing tariff on Chinese imports. That could have impact on American inflation that will restrict Fed's ability to cut interest rates. Coming to Indian economy, well, we remain economy which is growing at the fastest pace. It's oasis in the global desert. But when we look at election result, certainly there is a segment of voters which doesn't think like this. Why is that happening? Well, due to COVID, our economy started growing below trend line. And even today, despite sharp pickup post-COVID, it is still 7% below our trend line. Our train is running at a good speed, but it is running 1 year late. Some people standing on platform are feeling that train is not arriving on time. People who are sitting in the train, they are enjoying the speed. People standing on the platform are counting the waiting time. There is uneven growth. There are 13 districts in Western India, Southern India, Eastern India, and Northern India, which accounts for half of India's GDP. Balance 692 districts accounts for other half. Obviously, there is wide disparity between all these districts. We believe the government, which is formed with coalition partners, will have to make adjustments in the way it manages economy. There are certain executive reforms which has high impact and which are most likely to be carried out, like infrastructure push, like fiscal prudence, like R&D and innovation push, skill development, and so on and so forth. There are certain reforms like divestment, FTAs. It may go into back burner, but their short to medium term effect is manageable. There are certain reforms which will have high impact on our growth trajectory, but it may require more negotiation. For example, farm reforms, Electricity Act, strategic divestment, labor reform, judicial reform. All these things will take more time. We believe eventually the economic fundamentals of India will ensure that show must go on. I had written an article in Indian Express talking about what could be the agenda for the next government. They need to focus on creating jobs and employment and boosting consumption without losing fiscal prudence path. Headlines in the month of May 24 were reasonably positive. The GST collection came at 1,73,000 crore, 10% year-on-year growth. Our FY24 GDP growth came at 7.8%, higher than expectation, and FY24 full year growth came at 8.2%, well ahead of expectations at the beginning of the year at 6%. This GDP growth was driven by government spending, which continues to remain driver for GDP growth. The private consumption remains on the slower path, and there was some contribution from the trade. Effectively, we can say that Indian GDP engine is running on government capex, some amount of trade, and subdued consumption, as well as private capex. Domestic activity in the month of May slowed down a little bit because of the heat, but overall capacity utilization continued to remain around 75% level. Government's capex, as I mentioned before, has continued to rise since FY 2019, and now about 3.5% of GDP is government's capex. Is there a room to maintain path of fiscal prudence? Answer is yes. The RBI has given bumper dividend, highest ever dividend of 2,10,000 crore to government thanks to deployment of FX reserves at higher rates. The total growth year on year is about 1,23,000 crore in RBI dividend, which gives substantial room to Government of India to manage the budget. While Indian manufacturing goods export is not growing as rapidly, the services goods exports have been growing at a much faster pace. Our service export share is 3 times more than goods export share. Services exports are led by global capability centers. It is estimated that about $46 billion worth of exports are made in global capability centers last year. Defense exports has crossed 21,000 crore last year, and electronic exports are also growing at a reasonable pace of about $30 billion a year. Can we go and capture opportunity available as US has levied import tariffs on Chinese goods? Look at something like syringes and needles. There is 50% import duty on Chinese goods. Our syringes and needles manufacturer should be able to capture this opportunity. Credit growth remains robust in double digit. Banking sector has slowed down credit growth, but still it is in double digit. Crude oil prices have remained very well behaved and now is trading below $80 a barrel. This drop in crude oil is coming as OPEC and Russia has announced restoration of production cut of 2.2 million barrel from second quarter of 24. There is also about 6 million barrel per day of spare capacity, which can be added over here if the need arises. In terms of our economic parameters, compared to emerging markets, we continue to remain on a firm position. Even Standard & Poor rating agency has improved India's outlook to positive. Hopefully, subah ka bhula, sham ko ghar laut aayega. Where are the challenges for Indian economy? The rural wages haven't grown in real sense in a meaningful manner over last decade. The inflation has taken away reasonable portion of rural India's wage growth. India's IT sector last year didn't recruit 1.5–2 lakh employees, which they normally recruit. In fact, they didn't even replace 67,000 employees which left. Artificial intelligence seems to be having impact on tech industry's jobs. Foreign direct flows, while they declined from $85 billion to about $65 billion, on a net basis, there was a significant drop as a lot of private equity people booked profit and took their capital out. Converting this into equity market, well, now our market cap is in excess of $5 trillion. On a first time in our country, in our history, we have achieved that. If we look at March 2024 quarterly results, there were sectors where numbers were reasonably good in shape, like financial services, aviation, telecom, some mid-cap IT companies, NBFCs. But there were many sectors like gas, energy, where results were below expectation. Overall, we are on course to achieve about 1142 earning per share for Nifty 50 this year and 1327 earning per share for FY 2026 for Nifty 50 companies. For NSE 500, it will be 909 rupees and 1069 rupees over next year. The ROE of Indian company continues to hover in the late teens, and corporate leverage is extremely low, indicating healthy balance sheet. Our weight in MSCI has kept on going up and touched almost 18%. Despite that higher weight, FPIs have been sellers in Indian market year to date in both April and May. One good thing about retail investors' maturity was witnessed in this volatility. When FPIs were selling in April and May, and when they were shorting markets towards election, retail and domestic mutual funds kept on buying. On the exit poll announcements, when market became euphoric, FPIs bought and covered their short, and retailers liquidated and booked profit. On the result day, when markets corrected, FPI sold, they even shorted, and retail investors bought back what they had sold previous day at much lower prices. Thrice in a row, ahead of election, on exit poll announcement and on actual result announcement, retail investors were on the right side and FPIs were on the wrong side. Our market cap to GDP ratio at 132% is higher than historical average of 80%. Our profit to GDP ratio is also higher over historical averages. Corporate debt to GDP ratio has come down. Put all these things together, valuations have remained in reasonable range. Large cap trades at 4% premium, 19.2 times forward versus average of 18.5. Mid cap, small cap trades at about 29-27% premium to historical average. Within this historical average, we need to remember that in the Nifty indices, over a period of time, low PE ratio PSU companies have gone down and high PE private companies have come in. Domestic companies have increased their share. Global companies in IT, pharma have decreased their share. B2C or business to consumer companies, which are generally trading at higher valuation, have come in, and companies which are B2B and trade at a lower level have come down. This also increases Nifty's PE ratio. One caution in the market, the small and mid cap are now about 37% of the total market cap. The large cap is at about 63%, and hence you need to be careful in small and mid cap. Number of companies which are trading at 50 times forward PE and 10 times, and which has increased 10x over last 10 years, is almost 104 companies. 9 companies have PE in excess of 100x. This is one of the highest in recent times, and one will have to be careful in expensive stocks. We have been cautioning people on low floating stock counters having run up significantly. There are companies where floating stock remains limited, and that's putting undue increase in that's resulting into undue increase in valuation. It's time to be cautious over here. Our view in the market, be neutral weight equity with some bias towards large cap. Across our portfolios, balance advantage fund, we are in the middle as we have maintained neutral allocation with 53% in equity. And in our Kotak multi-asset allocation fund, we are at similar level at 55%. We think markets are fairly priced, and one can maintain neutral allocation to equity with bias towards large cap. Going forward, when will Fed start cutting rates? Will oil remain at $80 or below? Will government give boost for consumption? And will there be any flow out from Israel, Hamas, Russia, Ukraine, China, Taiwan confrontations? If those things don't happen, markets will continue to rise. If those things happen, markets can slide down a little bit. But be assured, that this time our fundamentals are in place, our growth is growing strong, and hence every correction is a great opportunity to buy. Coming from equity investment opportunity, our SIPs continue to do well, and across various time frame of 3, 5, 7, 10 year, we have delivered positive return, positive alpha over benchmark index. The same is true in our hybrid funds as well as sectoral and thematic fund. When we look at point-to-point return, then bearing a mid-cap fund, in most of our funds, we have delivered alpha over benchmark indices. Instead of going to ETF and index fund, it will make sense to be an actively managed fund which can add value to investors. This is true in our hybrid funds as well as sectoral and thematic funds. If we look at rolling return, again, bearing few exceptions, we have delivered return on a consistent basis across our debt as well as equity product. 3 funds which are worth recommending at this point of time: Kotak Equity Opportunities, Kotak Equity Contra, and Kotak Multi-Cap Fund. These 3 funds have consistently delivered more return than benchmark indices, and the performance is truly satisfactory. One fund which we had launched 7 months ago is Quant Fund. Kotak Quant Fund has delivered alpha since inception of about 24%, albeit only for a shorter period of 7 months. But one can see tremendous performance in Kotak Quant Fund thanks to the disciplined process. We are also launching Kotak Special Opportunities Fund on 10th of June. It's a thematic fund. It's a flexi cap fund which will go across market capitalization, be it small, mid, or large. What are special opportunities? Well, policy changes. For example, government said we will not import any more defense equipments or defense items in this 120 items. Straightway defense companies got re-rated. Mergers and acquisition, we have seen how HDFC and HDFC Bank merged. It created anxiety among investors and the stock underperformed. Industry consolidation, in aviation sector, when Kingfisher Airline shut down, SpiceJet slowed down, Air India was going through trouble, that market share got consolidated in favor of companies like Indigo. The stock did very well. Management change, when a bad management goes out and new management comes which can take the bull by horn, the company's growth orbit changes. Buyback, again, L&T started buying back shares. It created a floor for their price. We saw the same thing happening in Infosys. Companies can also have operating and financial leverages. These are all the special opportunities which exist at various points of time. In our normal fund also, we keep on accepting this kind of opportunities. We kind of invest into such options, such opportunities. But in our existing fund, because of size and because of benchmark allocation, the opportunity capture is on a smaller quantum, not on a larger quantum. In Kotak Special Opportunity Fund, this will be concentrated portfolio focused on this kind of opportunity. Look at the debt index, defense index, how since 2020, it started performing when government started putting restrictions on import of defense goods. We have seen in persistent system, when a new executive, new manager was brought in, it turned around the company and the underperformance of the company to excellent outperformance. When Praxair and Linde got merged globally, there was also merger in their Indian subsidiaries. that created economies of scale, and Linde India now has delivered good return to investors. Let me take you through partly paid up share opportunity. Let's say company issues 10 rupee shares and also partly paid up share of 2.5 rupee. After 1 year, stock goes up 25% and now trades at 12.5 rupee. What will be the price of partly paid up share? Well, the price of fully paid up share 12.5 minus call money of 7.5, which one has to pay to make this share fully paid up, and the share will trade at about 5 rupees. In the fully paid up share, when you got 25% return, in partly paid up share, you got 100% return, 4 times more. This can happen reverse way also, but hopefully we'll capture partly paid up opportunities in a positive manner to add value and not deduct value. We remain bullish on consumer. One, because of the election verdict, there will be focus on boosting consumption. Monsoon is expected to be good, and government has spent money around election and post-election, which should support consumption. Indexes, which hasn't done very well over last couple of years. One, FMCG, 1 year, 3 year trajectory is underperformance, and hence we believe now time has come to accumulate FMCG because of good monsoon, because of government's spending, and because of potential consumption boost in budget. Bank again has not delivered as good return over last 5 years. Their valuation has been derated. The NPA levels are low. Deposit and growth is fine. Time has come for private banks to start delivering. IT sector again has underperformed the market. We believe if IT sector starts seeing volume growth, the stocks can get re-rated from here. We'll have to wait and watch for September commentary in the September quarter to figure out what IT industry is up to. We believe it's time to go long private bank and FMCG post the election result, and at some point of time, IT might become attractive to invest into. You can capture these 2 themes by Kotak Consumption Fund or Kotak Banking and Financial Services Fund. Both these funds are good from a thematic stroke sectoral exposure. Coming to fixed income market, US inflation started easing off. Their GDP growth also started slowing down. US Treasury yield in anticipation of Fed rate cut started coming down, and now 10-year yield is trading at about 4.5% level. Fed is expected to cut interest rate twice in this year. Earlier, the expectation was 1, but thanks to Bank of England and Canada, thanks to European Central Bank and Canadian Central Bank announcing interest rate cut, market expects Fed to cut interest rates twice in current year. The RBI has played fantastic melody. They are managing growth, inflation, rupee, liquidity in a seamless manner that gives confidence to Indian debt market. Our core inflation is below RBI's target range of 4%, and headline inflation is within 6% to 4% range given to RBI. Next year, inflation is likely to come around 4.5%. This is lower than what market is pricing in. GDP growth of India will be 7.2% for FY 2025. That will make India one of the fastest growing major economy. Can this GDP growth come under pressure? Yes, there are 2 wars raging in the vicinity. Energy prices and commodity prices should remain subdued. But subject to that, we are looking at 7.2% GDP growth for FY 2025. Liquidity has remained ups and downs, not because actual liquidity is high or low, but more because of government spending and government keeping taxes with itself while it is spending. The 10-year government bond yields of emerging economies, India trades at one of the highest yield. It is even higher than a country like Indonesia. Foreign ownership of Indian bond is less than 2%, which makes Indian bond a very attractive asset class for foreigners. Time to accumulate long duration. Interest rates are unlikely to fall flat if the time has come to accumulate long duration, and we believe long end of the curve will outperform every other part. On the debt side, when you are looking to invest, do consider hybrid and debt schemes. If your client is not paying high tax, it is not in tax bracket, then for parking money, one can look at Kotak Money Market Fund. And for longer term investment, it can look at Kotak Debt Hybrid Scheme. For someone who wants regular cash flow, Kotak Debt Hybrid Scheme, Kotak Balance Advantage Fund, Kotak Equity Savings Scheme are more appropriate vehicle. For high taxpayer, for parking, they should look at Kotak Equity Arbitrage Fund. And for low taxpayer, they should be looking at Kotak Money Market Fund. Kotak Equity Savings Fund is one of the top performing fund. For HNIs, looking at fixed income kind of low volatile return, this is one of the best option in the market today. If you look at gold, we believe central banks buying will continue. In 2022 and 23, they bought 1,000 tons of gold, and current run rate is also indicating similar level of gold purchase. Gold's market share, will just take a break while this announcement is going on because you won't be able to hear me. Sorry for the disturbance. Gold allocation in investors' portfolio today is just about 1% globally. It used to hover upwards of 20% for many, many decades. Both this combination, low allocation investment in gold and central bank buying, gives us hope that gold prices will continue to remain supported. Look at the chart. It shows what was gold holding by central banks. There was a time when 80-90% of central bank's foreign exchange reserve was parked in gold. Over the years, their ratio kept on coming down, and now finally it seems to be going up. Today, central banks around the world has more exposure or investment in gold than what they have in currencies like pound and euro. Hopefully someday it will grow even further from current level. Finally, gold prices do get supported whenever US Fed cuts interest rates. That's evident in the past cycle. Whenever US interest rates came down, gold prices have gone up. This time also we expect US interest rates to come down, and that should be supportive of gold. Gold and silver ratio is neatly balanced. I think it is time to be long silver also. In Kotak Multi-Asset Allocation Fund, we have exposure to silver through silver funds.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.